Welcome to TheoTrade. This is Don Kaufman. It's April 8th, 2019, and you are watching the TheoTrade evening video. Just a couple of moments after the cash close, and what do we see inside of the broader markets? Well, for the most part, across the board, we are massively unchanged. I mean, if you want to get specific, you want to get detailed, sure, the S&Ps are up 2, the NASDAQ is up 20. The Dow faded. It's down about, 60. At least the Dow futures are down 60, but that's specific. I mean, listen, when it comes to the Dow futures, it's all about Boeing, Boeing being the largest constituent inside the Dow. But really, net, what you have in today's trading session is a market that is massively, again, unchanged. With that, I think this provides us a perfect time to discuss, kind of the moment of truth for markets, moving forward. And what's the moment of truth? There's going to be some very specific news announcements coming throughout this week, which I'm going to detail here momentarily. But even more specifically, we have to discuss a little bit about what earnings are going to reveal in the coming days and coming weeks as, again, broader S&P 500 is about to pass through earnings. Kicks off later this week, specifically Friday. JP Morgan is kind of the start now of the major earnings season. Before I jump over to some of these news announcements and earnings, let's just look at the S&Ps for just a brief moment. So the S&Ps are ever so slightly shy of the 2,900 mark. Now, I just want to bring this up because, again, the S&Ps, they're butting up against a major level, and it just looks like we're prime right now to cross right through it. And in fact, we're probably going to do that in after-hours trade. Now, another aspect that I want to kind of bring into perspective, we do effectively have a gravity point inside of the S&P futures, and it's right here, which is equivalent to 2911. Again, I wanted to highlight that to make everybody aware, gravity point to 2911. So effectively this evening, futures reopen here. We got a little bit more push to the upside, possibly when Chinese markets are open in the middle of the night. We don't just cross through 2900, but we could get, again, markets kind of levitating and even gravitating during tomorrow's session. That's going to be Tuesday, April 9th, right in and around that 2911. So just be mindful of, again, very key inflection point kind of in play. The other aspect I'd like to bring into scope today is the bond market. Now, don't read too detailed into the bonds right now. The bonds, we're still, again, very capable of exploding back to the upside today. Finished almost largely unchanged. Again, 10 ticks, all right, on the bonds, about 4.5 ticks on the ZM. What you have, though, is absolutely no volume. It's effectively the lightest day that we've seen, okay, in recent history in the bonds. And I just wanted to highlight that because a lot of people probably looking at the bonds today, they're like, what happened to the bonds? Again, just highlight this across the screen. I mean, you realize in terms of the bonds, you got to go back to Christmas and New Year's kind of time frame. All right, this is like New Year's Eve to see bond volume as low as it was today. So I don't think not only can't you really read into the S&Ps a huge amount today, but you definitely don't want to read into the bond market. If you're not going to read into the bond market, you can't read into what's going on inside of the financials. I mean, today is a mulligan. Do-over, Groundhog's Day. We'll be back at it tomorrow. Now, let's get down to some of the announcements that are really going to impact markets. And again, I really want to put some emphasis on these announcements because if you were to look, and we will momentarily, if you were to look at implied volatility, okay, and we'll get real specific. We're actually going to look at implied volatility in the SPX here momentarily. Before I get to that, all right, let's just fast forward to Wednesday, which is April 10th this week, okay? We have some announcements coming out this week, and you just don't feel the hesitation, the anticipation, okay, in terms of the implied volatility. And let me bring you into full scope over here. This is an ECB announcement. That's Mario Draghi and crew. Effectively, what am I saying? Okay, well, Mario Draghi is the European Central Bank's, their version of the Fed. They're going to come out with an announcement. Now, why is this going to be, big this week? Listen, it was only a few months ago that the ECB was also like, all right, we're gonna tighten things up. We might get interest rates off zero, okay? Now you actually have Europe, what almost feels like is in shambles economically. Italy is actually in a recession. Germany is most definitively in a recession. They haven't called it yet, but I'm calling it. Pretty much time of death over here. They're probably in a recession. So you're likely to see some movement out of the ECB and Mario Draghi. And again, never forget where Mario Draghi is from. He's Italian, right? And he's actually watching Italy, okay, firsthand go through what is turning out to be a rough economic recession over there right now. The other thing, be mindful of, Mario Draghi kind of wraps up his term here in, kind of the later portion of 2019. I don't think he's going to hold back. I think the guy's actually going to juice the European economy. How the markets are going to accept that is a completely different story. Nevertheless, expect some movement out of the ECB. Are they going to turn the spigot back on and be like, quantitative easing is here forever? The ECB has been heavily into corporate bond buying. And again, they may turn that effectively back on, not to to mention maybe other measures that could be at hand. But you have to also recognize there's a huge amount of Europe right now that's in, NIRP, negative interest rate policy. So again, it's a binary kind of event. I don't want to go any further than that and tell you it's going to rally the market, sell off the markets. But you better believe markets, they like, when the Fed and or the ECB is going to be accommodative. Speaking of accommodative, you also on Wednesday have to deal with FOMC minutes. Now, nobody necessarily knows precisely what goes on between Jerome Powell, and the rest of the Fed, but you get a little bit of insight there at the Fed minutes. The Fed minutes might be a bit of a dud, but again, on Wednesday, expect that we're going to get more insight to what is going on in the FOMC. And I know I, for one, want to see what caused not only the about face, but people are going to look at these FOMC minutes and they're going to read extensively about why is the FOMC leaving the balance sheet just below that about $4 trillion level. So they're kind of there was quantitative tightening. It lasted a couple of days. There's quantitative tightening, but they're actually going to turn off the quantitative tightening and leave the balance sheet just south of about $4 trillion. I think we're going to get some more insight on that, right? By the way, with that, there's also going to be some Fed speak throughout the course of the week. Jerome Powell, again, I would put that aside. My money, is right here at the ECB. I think the ECB could possibly rock U.S. markets, not so much the FOMC minutes. So it's never a dull Fed fun fest. With that, though, I don't see anything being priced in to these marketplaces in terms of implied volatility. And I can't stress this enough. If you're selling options premium this week, I have to actually stop and ask you, are you out of your mind? It's an 8.4% implied volatility. You don't sell an 8.4% implied volatility. In fact, go a little bit more detailed over here. If you take a look at implied volatility, look at some of these at the money calls, 6.5%. People, you look at this and you want to be a net buyer of premium. Now, I know that absolutely nothing happened today, but nothing can happen 3 or 4 days in a row. You only have to have that something happen once during the course of the week, and that could really pay off big in such an incredibly low implied volatility environment. In fact, just to kind of calculate this, you realize the entire rest of the week holds just shy of a $25 expected move. Again, inordinately low implied volatility in a period of time where not only do we have ECB coming out and FOMC minutes, shove that aside, what's earnings going to start to reveal? That kicks off later this week. Let's jump to it. One of the ways that I look at earnings, is I actually will scan for it, and I'll scan specifically here under weeklies. I just want to see everything that has weekly options, because stuff that has weekly options, it's fairly liquid, not always liquid, but relatively liquid, and they start to become the major players. So in the next 7 days, so I said earnings, has earnings anytime in the next 7 days. What do you got? Well, what's up to bat? Bank of America and so forth. But as I said, what really kind of kicks off the earnings season, for me anyway, is right here. It's JP Morgan. You're even going to get Netflix next week. People, it's going to be a party. All right? A little bit of tech, almost all the banks, throw a couple of airlines in there, maybe even an IBM, you got yourself a party. Now, I'm not going to go into individual earnings just yet. I want to give you just a broader feel for what I would expect, okay, for, again, we're end of the first quarter. It's time to basically throw your chips on the table. What can you expect over here? Well, a bunch of these stocks that are about to pass through earnings, and I'll take the banks initially, okay? The banks, well, it's going to be difficult to determine how are they going to fare. Why? Well, first thing that you have to deal with in the banking sector, okay, is now we're actually discussing a lower interest rate environment. Again, 2 quarters ago was the exact opposite, and they were all banking. The banks were banking on rates being a little bit higher. Now, interest rates are a little bit lower. But the positive side for the banks, okay, is that sometimes, well, investment banking, some of the release of IPOs can actually be extraordinarily positive. It's going to be a vastly mixed bag of goods for the banks that are initially coming out. And the reason I'm telling you this, okay, is because I don't want you to be caught in the crossfire of trying to use banks to handicap what the rest of the earnings season is going to look like. Because the banks, JP Morgan has got, bullish position in bonds, fantastic. Meanwhile, Morgan Stanley is going to be on the wrong side of the bond trade, and they're going to get absolutely hammered. I'm just giving you an example. Whoever was involved, of course, in some of the recent, IPOs, maybe got paid out a little bit, okay? And they're all going to, elaborate upon how investment banking, again, which is bringing some of these IPOs to market, is looking pretty good for them. So it's going to be, again, a wildly mixed bag of goods in the banks. Don't use that as a litmus test for the broader S&Ps. Now, when it comes down to tech stocks and when tech start to release some of their earnings, again, this is going to be kind of the moment of the truth. However, and you might not like what I'm about to say over here, when earnings come out, they're going to mask it. I believe that the earnings are going to be broadly masked this time around. Why? Well, CEOs and CFOs are going to sit down and have a conversation. That conversation is going to go something like this. Listen, interest rates, they're not going up. This is exactly what these people are going to say. Okay, they're going to sit down and they're convince the board. Doesn't matter. Interest rates are going to be low. They're going to be low for a sustained period of time. So what are they going to do? They're going to borrow money. They're going to go out. They're going to buy back more stocks. Not going to matter too much of what these earnings happen to be. In the near term, they're going to buy back stock, cover up their mess. Okay, bid stocks higher. Now, I happen to be a bearish participant in the broader marketplace. But my bearishness, it's not just predicated on what these earnings are going to be. I'm telling you right now, they're likely, even if they miss earnings, it doesn't matter that much when you miss your earnings per share and you announce a multiple billion-dollar stock buyback. They just bid the market right through, which could effectively be bad numbers. And again, I really think that they're going to come out with a substantial number of buybacks over here, bidding markets higher. Nevertheless, that will not change my position, neither near term nor far term, on the broader markets. And what's that broader market position? Upside potential versus downside risks. This is still a wildly precarious time. We're in the very near term. What are earnings going to reveal? I'm telling you right now, they're not going to reveal much of anything because we're going to bid through it with stock buybacks. The marketplace, though, is literally on pins and needles. Even though in the short term, I can absolutely, as a trader, not only anticipate, but kind of feel some upside potential in here. Nevertheless, the downside risks that prevail, are too much to handle. If you want to be bullish in the near term in the broader markets or an individual stock, don't get long the stock. Don't get long the spiders. Use, short duration, low risk and defined risk trades in effort to get long in the near term, much of which I'll discuss and continue this conversation tomorrow live in the TheoTrade chat room. Thanks, everybody, for joining us here this evening. Have a wonderful evening. Bye-bye.